Maybe. Of course, it's a big problem if it doesn't get resolved. But assuming that we get a deal, if we get a deal next week, then we have two issues. The first one is market pricing for the Fed. The market prices the central bank effectively to cut rates right after the final hike, which we assume we just got with the latest meeting. We disagree with that view. We think this is a hawkish pose. It's not the pivot from hawkish to dovish. It's a pose. The level of inflation is high, the level of market is tight, and so markets can be disappointed if the Fed doesn't lower rates. That's the first issue.
The jobless claims remain brilliant by historical standards. They are really, really strong. The JOLTS data, it's weaker than it was, but it's still really, really strong. So you've got this very difficult situation where there's a lot of flashing red signals, the housing market, with the consumer potentially, and yet people have still got jobs. Why would the Fed cut, as is the most likely scenario according to the Fed Fund futures, with that as a backdrop?
Indeed, this seems an implausible scenario, and it is only the first issue. The second one is that the tension here is that if the labor market remains strong, if economic activity doesn't eventually deteriorate to a point to have a recessionary environment and disinflation, the Fed may have to tighten policy more aggressively, and then you have recession, including an earnings recession.
Let me just go through that. That is stunningly important, and stunningly important for you who have long the market at the moment on the basis of the Fed cutting. The Fed may have to cut more aggressively into the tail end of this year. Is that your base case?
The Fed may need to hike more aggressively if inflation stays elevated.
Yeah, that's not priced in anywhere.
So just to get into that scenario, cooling of economic data is one thing, but the pace of cooling is another. And what we've seen in the labour market, some encouraging numbers, but not back to the 150,000 or less job creation that the Fed has wanted to see. Same thing as we take a look at the retail data this week. It's encouraging. Consumers are changing their behaviour. They're starting to feel the impacts of higher rates and all the other pressures. But how quickly does the data need to change to ward off further rate hikes at this point?
Right. Look, first of all, I think the pace is very, very important. Of course, the level of rates is important as well. This operates with a lag, fits through when mortgages are reset, they are renegotiated. So it's fair to say that we are seeing some effect on the economy. You mentioned some important data points. Even wage growth is no longer booming. It's simply very strong, simply solid. So it's going to take time. It seems to me that the pause is probably warranted. One wants to see what are the effects on the macroeconomy. But lowering rates at this point, especially if the labor market remains that solid, is not warranted, and we disagree with that market pricing.